With the Bank of Canada's last two rate hikes, it completely froze the real estate market in the GTA. It spooked the buyers from buying, and it freaked out a lot of buyers in the exact same time. So everyone is watching the next move that the Bank of Canada is planning to make, and that move is on September 6th. And what can we expect on that date? I'm going to be giving you kind of my perspective and my analysis of what to expect on September 6th, whether we're getting a rate hike, a pause, or a rate cut. So make sure to stay tuned. Now, if you're wondering how to kind of position yourself in the real estate market for the upcoming fall market, knowing what may happen with the rate hike, whether you're buying or selling, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zen, and I run and operate a RE/MAX in the Greater Toronto Area, on top of making awesome educational real estate content just like this one. And if you find any of these videos helpful in your real estate journey, whether you're buying, selling, or investing, make sure you spread the knowledge by smashing the like button and subscribing to the Prime Props channel. This way, it kind of gets a lot of information out there, especially when it talks about like interest rates. There's a lot of stuff out there. I'm just trying to give you my perspective of how I'm reading it and how it applies to the real estate market. So, if you could help smash the like button and subscribe, that'd be much appreciated. So there is a rate announcement on September 6th, and everybody is kind of talking about, is there going to be a rate hike? Is there going to be a pause? Or is there going to be a rate cut? Look, I can probably rule the rate cut part, and I'll show you why. But honestly, if you ask anybody, the truth is nobody knows, right? Really, nobody knows. Remember, the most bearish person was Scotia's economist, and they even came under with their kind of super bearish forecast of how many rates we got, meaning we got way more rate increase than even he thought. But if you force me to give you an answer, what do I think is going to happen on September 6th? I say there's like a 40% chance of a rate hike, and I'm going to show you why in this video. Remember, things can change with new data, and when we get new data, we should have new output, right? And we're going to be getting a whole new set of data in like the next few weeks in regards to how the economy is doing in the latest CPI, which you'll see why I think it's going to go up. But let me show you why I think there's a very good chance of rate hike, right? So we know right now that the Bank of Canada's number one mandate is to bring inflation back down to their target range between 2 and 3%. So I'm going to put a chart over here, and you can kind of see the history of what's going on. We just got a 2.8% CPI print, but I've talked about this in the past before that I totally was expecting this inflation to come back down because, again, this is all due to a math thing called base effect. And I suspect it will go back up in the second half of 2023, meaning the next CPI print, I suspect it should be high or higher than what in June. So this is why I expect rates to be higher for longer. So the first component of why I think rates are going to stay this way, like I was saying earlier, is because of base effect, which is just like a fancy term in stats. If you remember stats in grade 11 or grade 12, I think grade 12, right? Just kind of comparing year over year numbers, right? Because if you look at this chart over here, again, it's a little bit confusing, but let me explain, bear with me. CPI is measured by comparing last year's number to this year's number, okay? It's always a yearly comparison. So my expectation was that in June 2023, meaning the last CPI print, it would come in very low, just strictly because of math, the base effect. And the reason for that was June inflation in 2022, so the previous year, was the peak, the highest, the pinnacle, the zenith, which was at 8.1%. So when you compare that to anything else, it's going to look like it came down just from a perspective, right? From that perspective. Now, if you look at the chart here on a month-to-month comparison, which is what each box is, in the first half of 2022, you can see that as it's shown in red box, inflation was increasing each month, a pretty high number. You take those 6 red boxes, the average was 1% month over month change, which is very, very high. Now, if you contrast that to the first half of 2023, green box, right, where again, inflation is still increasing, just not as fast. It was averaging 0.43%. That's obviously 57% lower. So it looks like if you compare that, it's coming down by a pretty big amount. So when you compare inflation on a year-over-year basis, that's kind of what you get, and that's the base effect. Now, if you look to compare the upcoming months of inflation prints to last year at the same time, so the second half of this year to the second half of last year, it tells a totally different story. You can see since we peaked inflation in June 2022, the 8.1%, the numbers in the yellow box, right, are starting to get smaller and smaller. We were getting disinflation, meaning still getting inflation, meaning still going up. It was going up much faster in the red boxes than it was in the yellow boxes on the chart, right? So we actually, in that yellow box series, had 2 months where we got deflation, where the number was negative, right? So when you compare the second half of 2023, that's coming up, to last year's second half, inflation from the same base effect that we saw earlier in our advantage is going to be in our disadvantage as it's going to be going up. So the average inflation month over month in the second half of 2022, which is in the yellow box, was 0.16%. It's very low. The average inflation we've been getting in the first half of this year, like 2023, which is the green boxes over here, was 0.43%, which is about 2.5 times higher than last year. This means if inflation in 2023 keeps pace at what we've gotten this year in the first half, it's going to be higher than last year. Again, this is just math. It's base effect. So in this chart, when you forecast it out, you can see that if we average a month over a month change in inflation, even at 0.1%, which we haven't gotten anything remotely close to that on average in the last 18 months. We did a couple months here and there, FYI BTW. The ending CPI will still be above 3%, which is above the June 2.8 print. See? So if we get the average inflation for the remainder of the few months we saw this year in the first half of 2023, and we end this year with the same amount, we're going to have a CPI print above 5. This is just math. It's just math. So this is why I've been saying, don't celebrate the June inflation print that we got last month. This was expected. We're not out of the woods yet. Really not. Remember, the target inflation rate is between 2 and 3%. We're going to come in hot at the end of the year. Now, how can we get like monthly inflation prints of like 0.1% or even deflation to bring it back down at the end of the year so that we can see some of the same numbers we saw last year of the second half of 2022? Well, ironically, the first thing is mortgage interest costs, which are built into the CPI calculations. And you can kind of see in this chart over here that it spiked really hard by 30%. And it's essentially contributing to 1% of the headline inflation. Ironic, right? Because this mortgage rate is also controlled by the Bank of Canada raising the interest rate, who is trying to bring inflation down, but by raising interest rates, they're actually also increasing inflation. Again, very ironic. So this chart here shows that if you remove the mortgage component out of the headline inflation, right, so the CPI print, you can essentially see that it brings inflation down below 2%. So is that the magic solution? Maybe. Now, I personally do not think the Bank of Canada is going to do that to bring inflation down because it honestly makes no sense. This is why when the mortgage stuff rolls over, inflation will look really soft. Now, the third contributor to inflation, that's a big component, is gas. And you can see in this chart here that gas has been coming down year over year in the last few months, right? Again, base effect there, and it's coming down. This is what contributed to the inflation coming down starting last year in the second half of 2022 around June. But now, if you look at gas prices in this chart, you can see that the prices are going up. And when I was driving the other day, I saw $1.60 a liter in Ontario again, which means that prices are going up. So if you look at this chart, when prices are going up, there's going to be a lagging effect on CPI where the gas, which is a big contributor, is going to go up, which means that we're going to get hit with some higher CPI numbers from the gas component just alone on that because the price of gas is going up. So this is all on top of the last few things we talked about. So when you understand kind of like these three things that I'm personally watching, even before the labor markets, you can see that the inflation has likely bottomed for the year, like this year, and it'll increase likely in the next print and for the next few prints after. This means it doesn't give the Bank of Canada cover for any rate cuts anytime soon. But at the same time, it also doesn't necessarily mean that they're going to be increasing it. Because if they understand that the economy has slowed down because of the last two rate hikes that they announced in June and July, they could very much just continue with their pause and wait for the effects of their last two rate hikes to kind of trickle into the economy, which, generally takes about 18 months to kind of lag behind. Anyway, speaking like just statistically. Now, I just, again, don't expect any rate cuts until I see a longer period of sustained disinflation, where inflation's coming down, or even deflation. But again, I don't think that's going to happen, right? At least not until the Bank of Canada think it's slayed inflation for good. I don't think it's going to have a rate cut. And again, the inflation problem is kind of self-created, right? Now, as for timing-wise, I probably don't expect any rate cuts until at least 2024. Unless, we obviously have some catastrophic financial event. And yes, then we'll get a rate cut. But literally nobody expected the economy to kind of not break with how high the rates are right now. So everything's kind of TBD, waiting on this dude to announce a rate hike, which is kind of wild if you think about it, right? Anyways, hope this gives you a little bit of perspective of how kind of I'm viewing things right now from that perspective. And when I apply a lot of that things to kind of the real estate market right now, this is kind of what I think is how it's playing out, right? I think some buyers may come back out of the slumber from the last two rate hikes if we see a pause in September on the 6th. But it definitely won't be as much as kind of what we saw in the early parts of spring this year, where we had a huge rush of demand, not enough supply. It kind of like the whole once bitten, twice shy. I think given that we saw a pause and then an unpause, most buyers are going to kind of wait for a longer period of sustained, pauses or rate hikes before taking any action, because they're just afraid of the rates. Again, unless the fixed rate markets kind of bottom out for whatever reason. Hence, this is why I think there'll be more buyers opting for the kind of wait and see approach than kind of jump in because of the pause. Because again, once bitten, twice shy. And as for sellers, depending on their own kind of unique situation, I would think they're opting to hold or to sell. And this is a calculation of risk tolerance for each person. So the would-be sellers, at least the ones I'm speaking to, are just kind of flip-flopping depending on their financial situation themselves to whether sell or list in the fall. And as for kind of the inventory spike we saw, it's kind of tailed off right now, which is kind of normal for August. And I'm also seeing a lot of listings being terminated right now. And whether they come back in the fall is TBD, because sometimes they do, sometimes they don't. So really, everybody is watching the September 6th announcement for sure to see what's going on, because that's going to dictate how the market's going to go. If we get that pause, I suspect we'll go back to a little bit of normal fall trends, not as crazy as spring, but normal fall trends. If we get a rate hike, I think it's going to be a rough fall market and a rough for the latter half of the second year of real estate, despite the fact that sellers can still continue negative amortizing, because it's going to spook the sellers that rate hike's on over. They're going to want to unload and unleverage. Anyways, hope this kind of helps you with your real estate journey. And if you want to work with our team who kind of understands all these concepts that I talked about in this video so that you can make the proper move and navigate the real estate market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that I'm done watching this video, I think you should check out this video. And you know what? Why don't you check out this video too?